Quick question. If I told you there's a stock that has already beaten both Nvidia and Palantir this year, not by a little, by a lot, would you want to know the name? Because it's true. Palantir has basically gone nowhere in 2026. Nvidia's up, but only single digits. Meanwhile, this other company is up somewhere around 80+% year to date. Same time period. Same AI boom. Completely different result. And here's the part that's going to bother you a little. I'd bet real money you've never heard of this company's name. It's not on any hot AI stocks list your friends are sharing. It doesn't make chips. It doesn't make AI software. It makes something way less glamorous. And that's exactly why almost nobody's talking about it yet. By the end of this video, you're going to understand the one part of the AI trade that basically everyone is ignoring, why that's a mistake, and the actual company that's quietly benefiting from it. Let's get into it. Here's the game plan for today. First, I want to show you why your brain, and basically everyone's brain, jumps straight to chips and software the second someone says AI stock, and why that's actually a blind spot that's costing people opportunities. Second, I'm going to give you a dead simple 3-part framework to evaluate any AI stock going forward, not just today's pick, any of them. Third, we get into the actual company, the real numbers, the bull case, and just as importantly, the real risks, because I am not going to sit here and pretend this is a guarantee, and because one company alone doesn't make a full picture, I'll also show you a second, smaller name in the same space so you can see this isn't a one-off story, it's a pattern. One thing up front, and I'm saying it now instead of burying it at the end, I'm not a financial advisor. This is research and education, not a recommendation to buy anything. Your money, your homework, your decision. So why does everyone's brain go straight to GPUs? Honestly, it's simple. Nvidia was first, Nvidia was biggest, and Nvidia's chips are the part of this story that's easiest to picture. A shiny piece of silicon that makes AI models think faster. Palantir picked up the second slot in the public imagination because its software story is dramatic, and its stock chart has been wild. Chips and software. That's the whole AI stock conversation for most people. But here's the thing nobody stops to ask. If you're building a facility that packs thousands of these power-hungry GPUs into one building, what happens to all the heat those chips generate? And where does the electricity to run them actually come from? This is not a small footnote. Building an actual AI data center costs an enormous amount of money, and a massive chunk of that spend has nothing to do with chips at all. It goes into power delivery and cooling. Modern AI GPU clusters run so hot that a standard office building air conditioning system would be laughably inadequate. We're talking about specialized liquid cooling loops, high-density power distribution, backup systems, the works. Industry estimates put the data center cooling market growing at roughly 22% a year through 2033. That's not a rounding error side business. That is the plumbing and electrical backbone the entire AI build-out is standing on, and if it fails, none of the fancy chips or fancy software matter, because the building overheats. That zoom out further and look at who's actually writing the checks. The big hyperscalers, Microsoft, Amazon, Google, Meta, are collectively planning to spend hundreds of billions of dollars on AI infrastructure this year alone. That money doesn't all go to chip makers. A serious slice of it goes to networking equipment, power systems, and cooling infrastructure. This is the layer of the AI economy that most retail investors scroll right past, because it's less exciting to talk about than the next Nvidia. But less exciting doesn't mean less important. Sometimes it means less discovered, which is a very different thing. Before I hand you a company name, I want to give you something more useful than a company name, a way of thinking you can reuse on literally any AI stock you come across for the rest of this AI cycle. Checkbox 1. Does this company serve a need that grows no matter which chip maker wins the race? In other words, is this a bet on the whole industry growing, or a bet on one specific horse winning a specific race? Betting on the whole industry is a much safer kind of bet. Checkbox 2. Does it have real, signed bookings and backlog, or is it just riding a future story that hasn't shown up in the numbers yet? A backlog is basically a stack of contracts a company already has in hand. It's a much stronger signal than a CEO simply saying, "The future looks great." Checkbox 3. Is the valuation still reasonable, or has the market already priced in all the good news so that even a great company becomes a mediocre stock from here? This one trips up a lot of investors, because a company can be genuinely excellent and still be a bad buy if you're paying too much for it. That's it. 3 checkboxes. Industry tailwind, real backlog, reasonable valuation. Keep this framework in your back pocket, because we're about to run 2 different companies through it. The main name today is Vertiv, ticker VRT in plain English. Vertiv builds the power and cooling systems that keep data centers running. If Nvidia's chips are the brain of an AI data center, Vertiv is closer to the heart and lungs, the part that keeps everything else alive. And here's the key detail that makes this pick genuinely different betting on a single chip maker. It doesn't matter who wins the GPU race. Nvidia, AMD, whoever ends up ahead 5 years from now. Every single one of those data centers still needs power delivery and cooling. Vertiv isn't betting on a winner. It's betting on the size of the whole game. Now let's get into the actual numbers, because this is where it gets interesting. Vertiv stock is up roughly 80+% so far this year, trading in the neighborhood of $300. After climbing off a 52-week low near $110, revenue grew about 30% year over year to $2.65 billion, which beat what analysts were expecting, and earnings per share also came in ahead of forecasts. For the full year, the company has guided toward earnings per share somewhere in the $6.30 to $6.40 range. Wall Street's consensus rating on this stock is strong buy, and the average analyst price target still implies further upside from current levels. Though, as always, price targets are opinion, not guarantees. There's also a specific detail analysts keep pointing to. Vertiv has been named alongside companies like Eaton and Schneider Electric as one of the key power systems parts tied to Nvidia's next-generation high-voltage architecture. The idea here is that as Nvidia's platforms scale up and get more power-hungry, the demand for Vertiv's power and cooling gear scales up right alongside it, almost like a toll booth that collects a fee every time a new AI data center gets built, regardless of which chip goes inside. Let's run Vertiv through our 3 checkboxes now. Checkbox 1, durable industry need. Yes, every large-scale data center needs power delivery and cooling, full stop, regardless of who wins the chip war. Checkbox 2, real bookings. Yes, this is backed by actual reported order growth and backlog, not just a story on an earnings call slide. Checkbox 3, valuation, and this is where I want you to slow down and pay attention because this is the honest part. After an 80+% run in a single year, a lot of good news may already be baked into the price. This stock is not cheap by traditional valuation measures. That doesn't mean the run is necessarily over. Some analysts still see meaningful upside from here. But it does mean the nobody's paying attention yet phase of this trade is very likely behind us. If you're coming in today, you're not discovering a secret, you're joining a story that's already partly told. I don't want to leave you with just one company, because one data point can feel like a coincidence. So let's briefly look at the competitive landscape around Vertiv, because it tells you this is a genuine industry pattern, not a one-off lucky pick. Vertiv isn't operating in an empty field. Eaton and Schneider Electric are both serious, established competitors chasing the exact same data center power and cooling dollars, and both have their own AI infrastructure stories worth researching if this theme interests you. The existence of strong competitors actually reinforces checkbox 1 from our framework. It confirms that the underlying demand for power and cooling infrastructure is big enough to support multiple large, profitable players at once. Not just a single winner-take-all. That's usually a healthier sign for a sector than one company having the entire market to itself. If you want a homework assignment after this video, that's it. Take our 3 Checksos framework and run it on Eaton or Schneider Electric yourself and see how the numbers stack up against Vertiv. That's a much more useful exercise than me just handing you a second ticker to chase. Now let's talk about what a lot of videos like this one conveniently leave out, because I'd rather you hear it from me than learn it the expensive way. First, competition is real, and it's not going away. Eaton and Schneider Electric are well-funded, well-established companies fighting for the same contracts, and market share can shift. Second, this stock has already had a massive run. An 80+% gain in under a year raises the bar for what counts as good news going forward. If growth merely meets expectations instead of beating them, the stock can still fall, simply because so much optimism is already priced in. Third, the entire thesis is tied to the broader AI capital expenditure cycle. If the big hyperscalers ever pull back on data center spending because of a slowdown, a shift in strategy, or just normal budget cycles, that would hit the whole power and cooling supply chain, not just one company in it. And fourth, some analysts have specifically flagged valuation as a concern after this kind of rally. A genuinely great business can still turn out to be a risky stock purely because of the price you paid to get in. None of this means don't look at it. It means do your own research, size any position sensibly, and don't treat anything in this video as a sure thing, because there's no such thing as a sure thing in the stock market. So here's the honest bottom line. The Nvidia and Palantir hype is real, and in fairness, it's earned. Both companies have delivered results to back up the attention. But the AI story was never only chips and software. The companies quietly keeping this entire build-out powered and cool have been some of the best performers of the year, and almost nobody outside of Wall Street analysts has been talking about them. That gap between how important something is and how much attention it's getting is usually exactly where the interesting opportunities hide. If this was useful, go ahead and subscribe. It genuinely helps this channel keep making videos like this. And drop a comment, had you heard of Vertiv before today, or is this a completely new name for you? I read all of them. See you in the next one.